Welcome back to Smart Stock Sam, the channel where we dig past the headlines and find the real story hiding inside the numbers. Today, we are going deep down into Poet Technologies, and by the end of the next few minutes, you will understand exactly why that title is not just clickbait. On the surface, this looks like a textbook collapsing bubble, a company caught in a genuine fundamental freefall. But if you look under the hood, if you track the dark pools, the options flow, and the short interest, a completely different story emerges. We are watching the formation of what could be a tactical short squeeze. In this video, we will break down the fundamental nightmare this company is facing, the exact mechanics of this option setup, and a highly specific, time-sensitive window between July 7th and July 10th, where this stock could violently reverse. Stay with me, because there is one hidden derivatives metric coming up that changes absolutely everything you think you know about this trade. But before we talk about the explosive potential upside, we have to look at the absolute carnage that brought us here. Right now, POET is a stock split into two entirely different realities. On one side, you have fundamental investors running for the exits. The stock has suffered a 55% correction from its recent highs, triggered by the loss of major Tier 1 customers and a valuation that is heavily, and I mean heavily, reliant on flawless future execution. It is bleeding out. On the other side, however, you have day traders and quantitative algorithms looking at a structural powder keg. We are talking about a short interest sitting comfortably above 20% of the float, technicals that are deeply, historically oversold, and an options chain heavily skewed with call options targeting the $10 mark. So you have a broken company on one hand and a beautifully broken market mechanic on the other. Could both of these things really be true at the same time? Let us find out. To truly understand the psychology of the traders trapped in this stock right now, we need to map out the exact timeline of this collapse. Let us look at the tape. Not long ago, POET was the darling of the speculative tech crowd, touching a massive 52-week high of $20.81. Euphoria was at an all-time high. Then the floor gave out. By mid-June, we saw a critical breakdown point near the $15 level, where major support absolutely failed. Panic selling set in, capitulation took over, and the stock was driven all the way down to an absolute floor, an intraday low of $8.62 in early July. Think about what that does to retail psychology. Over half your portfolio value wiped out in weeks. As of July 6th, we have seen a slight stabilization around $8.95, creating a very tight consolidation zone right above multi-month lows. When a stock compresses like this after a massive drop, does it usually just keep quietly bleeding out forever? Almost never. It tends to act like a coiled spring. Now you might be asking yourself, how could a $20 stock drop all the way to $8 so fast? Well, if we dig deeper into the actual numbers, the original valuation was defying the laws of mathematics. Welcome to what we can call the 770 times reality check. At its peak, POET was carrying valuation aspirations and capital-raising goals hovering around $830 million. That is a massive valuation for any emerging tech company. But what was actually backing that up? If we look at their actual trailing operating revenue, it was a microscopic $1.1 million. That gives this company a staggering price-to-sales ratio of over 770 times. Let me put that in investor-friendly terms. Imagine buying a local coffee shop for $770,000 when it only sells $1,000 worth of coffee a year. Would you ever sign that check? At a 770 times multiple, the current valuation requires absolute flawless execution of their 2026 to 2027 manufacturing ramp just to be mathematically justified. There is zero room for error. And unfortunately for POET shareholders, error is exactly what happened next. Two devastating operational shocks hit the wire. First, the Tier 1 cancellations. Two of POET's most crucial partners, Marvel Technology and Celestial AI, abruptly canceled purchase orders, publicly citing a breach of confidentiality by POET. In the tech world, trust is your currency. When Tier 1 partners walk away, claiming you leaked their secrets, the market reacts violently. This single event resulted in an immediate 45 to 47% intraday plunge. But the bleeding did not stop there. Enter Wolfpack Research. They released a blistering short report alleging severe systemic risks. They accused management of downplaying their passive foreign investment company, or PFIC, status, which risks dumping heavy, complex IRS tax consequences onto everyday retail shareholders. Wolfpack brutally criticized the company, calling this their seventh business pivot this decade, all while still generating near-zero operating revenue. Could this really be pivot number 7? At this point, even longtime followers of the stock have lost count. Now, none of this matters if we do not look at how management responded to these allegations when their backs were against the wall. Management is not going down without a fight. At their recent annual general meeting, CEO Dr. Suresh Venkatasan stepped up and tried to shift the narrative from fundraising to the factory floor. Their immediate promise for the second half of 2026, the volume optical engine shipment production ramp, is officially on schedule. They are deploying $50 million in capital equipment and hiring 50 new staff to scale up immediately. Their ultimate target for the end of 2027 is a massive 1 million units per month. To back this up, they announced a pipeline metric, claiming more than 10 active customer engagements that could potentially be worth over $100 million in future annual revenue. Big promises, but will they actually deliver on any of it? So we have a classic standoff between the bears and the board of directors. Let us weigh the evidence. If we stack the bear reality right next to management's vision, it is a glaring contrast. The bears point to this being the 7th pivot with no meaningful revenue. Management counters by pointing to the $50 million they just deployed for factory scaling. The bears scream about the devastating Marvel and Celestial AI cancellations. Management points to their pipeline of more than 10 active engagements, worth over $100 million. The bears warn of severe PFIC tax burdens waiting to hit shareholders. Management points to the $429 million sitting on their balance sheet to fund operations through 2027. Our fundamental verdict here? This is a stock with high execution risk. The burden of proof is entirely on management to actually produce the hardware they are promising. But while retail investors were panic selling based on this high execution risk, Wall Street's biggest players were doing the exact opposite. Here is where things get truly strange. Despite the 55% drawdown, despite the canceled orders, and despite the short report, institutional ownership just saw a massive 39.88% surge. Major, sophisticated funds like Jane Street, Millennium Management, and Citadel Advisors are actively holding or increasing their positions. Why would the smartest players in the room be buying a falling knife like this one? We will get to their hidden motive in just a moment. But first, we have to talk about the governance divergence. Immediately following the company's annual meeting, while retail portfolios were down 55%, 5 independent directors were granted 79,450 restricted stock units. Awarding yourself a massive stock bonus right after the destruction of shareholder value has drawn severe scrutiny, and frankly, it is a terrible look for corporate governance. But Wall Street institutions do not care much about corporate optics. They care about math, and if we look at the mathematical dashboard, a very unique setup is flashing. Let us open up the technical dashboard. Right now, every traditional moving average is screaming strong sell. The price of $8.95 is trading deep beneath the 5-day simple moving average of $9.02, the 20-day moving average of $9.24, and well below the 200-day moving average of $11.95. By every trend following metric, this chart looks completely broken. But if we look at momentum instead, the story starts to shift. The 14-day Relative Strength Index, or RSI, is currently sitting at 40.33, approaching deeply oversold territory. This tells us that the frantic, panic-selling velocity is finally decelerating. On top of that, the MACD indicator reads negative 0.20, which confirms deep structural exhaustion among the bears. Are the sellers simply running out of shares to dump? The numbers are starting to say yes. To see exactly where the buyers are waiting to catch this falling knife, we have to look directly at the order book depth. Looking at the immediate battlefield, we can see exactly where the algorithms are placing their bets. With the current price pinned at $8.95, we have an immediate baseline accumulation zone right at our first support level, S1, at $8.93. Below that, we have S2 at $8.88, and the absolute last line of defense before a total freefall is our S3 support at $8.82. This S3 level is critical because it sits just above that $8.62 absolute floor we established earlier. On the upside, if volume steps in, the stock faces an immediate ceiling at R1 of $9.03, followed by R2 at $9.08, and R3 at $9.13. The stock is trapped inside an incredibly tight, microscopic channel. But this tight channel is actually a pressure cooker because of the massive number of short sellers trapped inside it. This brings us to the pressure buildup. Right now, the short interest on POET sits at an incredibly elevated 17.75 to 20.54% of the total public float. The days to cover ratio is hovering right around 1.0. This means more than 1/5 of all available shares have been borrowed and sold short by traders betting this company goes bankrupt. When you have this much elevated short interest clustered at technical multi-month lows, it creates a literal structural powder keg. So here is the real question. If there is any sudden influx of positive momentum, or if options market makers are forced to hedge their books, what happens to all those short sellers? They get forced into a rapid, price-insensitive scramble to buy back their shares, creating a massive short squeeze. And if we look at the options market, we can see the exact trap that institutions may have laid for these short sellers. This is the hidden metric I promised you earlier, the option flow dynamics. Remember how I said retail is panicking? Well, the options market is doing the exact opposite. The put-to-call volume ratio is sitting at a historically low 0.19, indicating an extreme, overwhelmingly bullish skew. Just look at this open interest. We have a staggering 1,109,190 call options expiring on July 10th, compared to a measly 232,622 puts. Traders are betting serious money on the upside. Implied volatility is skyrocketing to 118.51%, meaning the options market is officially pricing in a massive expected move of plus or minus 8.23% by July 10th. There is even a massive speculative cluster of more than 11,000 call contracts sitting way up at the highly speculative $12.50 strike price. Is that realistic? Almost certainly not. But it tells you exactly how aggressive this positioning has become. So with all these millions of call options expiring on July 10th, where exactly does Wall Street want the price to close? The answer is the gravity well. Welcome to the Max Pain Magnet. For those new to options, max pain is the specific strike price where the highest number of contracts expire completely worthless, causing the maximum financial loss for retail option buyers and the maximum profit for the market makers who sold them those options. Right now, for the July 10th expiration, that gravity well sits exactly at $10. With overwhelming call volume expiring on this date, options market makers are structurally incentivized to hedge their books and physically drive the price action toward that $10 level to minimize their own payouts. It acts like an invisible magnet, aggressively pulling the current $8.95 price upward as we approach Friday the 10th. Could gravity really win this fight? We are about to find out. So what is all of this actually worth? Let us bring it all together and establish our final verdict. If we pull back and look at the big picture, we land on two very distinct verdicts. Long-term outlook? This stock is fundamentally uninvestable right now. The massive valuation disconnect, trading at 770 times sales, combined with severe execution risks like canceled orders and a looming PFIC tax burden, makes this far too dangerous to hold inside a retirement account. Long-term investors need to watch cash burn, Tier 1 customer reinstatement, and actual revenue breaking out beyond that $1.1 million baseline before ever touching this stock. However, the short-term tactical outlook, it is highly asymmetric and genuinely attractive. The combination of 20% short interest, deeply oversold technicals, and that extreme 0.19 put-to-call ratio targeting a $10 max pain creates the ultimate market mechanic engine for a rapid relief rally, which leads us directly into our exact trade setup for this week. If you are an agile short-term trader looking to capitalize on this options-driven mean reversion, here is the setup between now and July 10th. The primary trade objective is to ride this potential short squeeze toward that options expiration max pain level. We are looking to accumulate shares right in the $8.90 to $8.95 zone, directly near the closing price and our S1 pivot of $8.93. Because the fundamental risks here are genuinely high, we must use a strict, hard stop loss at $8.60. That is placed just below the absolute intraday low of $8.62 and our S3 pivot. If it breaks $8.60, the fundamentals have taken back control and the stock is in free fall, so cut the trade immediately. If the squeeze triggers, our first target is $9.61, which perfectly aligns with the 50-day moving average resistance. And if the momentum carries further, our final target is $10 even, capturing that option's max pain gravity well for the July 10th expiration. Quick reminder before we close out. Everything you just heard is strictly for informational and educational purposes only and should never be treated as personalized investment advice. Options trading, short squeezes, and small cap technology stocks like POET carry substantial risk, including the potential loss of your entire invested principal. Technical patterns, short interest figures, and max pain levels are historical observations, not guarantees of future price action, and markets can reverse instantly without warning. I am not a licensed financial advisor, and this channel is not a substitute for professional guidance. Always verify data independently, size your positions responsibly, and consult a qualified financial professional before entering any trade discussed in this video. POET Technologies right now is a genuine battlefield. It is a rough, long-term investment disguised as a fascinating short-term trade. Before you go anywhere, though, a quick and important disclaimer. Everything covered in this video is for informational and educational purposes only. This is not financial advice, and I am not a licensed financial advisor. Stocks like POET carry extremely high volatility and a real risk of significant loss. So please do your own research, think carefully about your personal risk tolerance, and consider speaking with a licensed financial professional before making any trading decisions. Now, I genuinely want to hear from you. Here is my question for the comment section down below. Do you think Wall Street's smart money buying into this sell-off is a genuine vote of confidence in POET's long-term turnaround, or is it simply a short-term mechanical bet timed perfectly around this option's expiration? Drop your honest take in the comments. I read every single one of them. If this breakdown helped you see POET Technologies in a completely new light, do me a favor and hit that like button. It genuinely helps this channel grow and reach more traders like you. And if you are not subscribed yet to Smart Stock Sam, now is the perfect time, because we break down setups exactly like this one every single week. If today's video brought you real value and you want to support the channel directly, you can also send a super thanks using YouTube's built-in support feature. Every bit of it helps us keep making deeper, sharper content for you. And finally, if you are serious about leveling up your investing or trading game, our channel membership is officially open, and it comes packed with real perks. You get early access to trade setups before they ever go public, priority replies to your personal questions, and even custom analysis done specifically on your request. If you want to trade and invest alongside a community that actually takes this seriously, come join us on the inside. Manage your risk tightly, keep a close eye on that options chain, and as always, stay disciplined. I will see you in the next one.